Washington expected Canada to falter, believing the negotiations would drag on with slow diplomacy, perhaps even yielding some compromises. Instead, Canada took an unexpected leap, cutting a direct path to China, leaving the U.S. behind. For years, the U.S. had a firm hold on Canada's energy exports, with nearly all crude flowing south. But now, that grip is loosening. With rising tariffs, increased tensions, and a new pipeline that completely alters the game, Canada isn't just talking oil, it's redefining its position. And for the first time in decades, Canada is creating its own playbook. Canada's energy was once almost entirely funneled to the U.S. One buyer, one market, one massive risk. But that's changing. The Trans Mountain Pipeline expansion now delivers 890,000 barrels of oil per day directly to the Pacific, offering Canada a direct link to global markets. China, the largest beneficiary of this shift, now has access to Canadian oil like never before. This is Canada breaking free, and with it, the U.S. is losing its leverage. In a world where global energy dynamics are rapidly shifting, Canada is making strategic moves to diversify its buyers and reduce reliance on one market. A 10% tariff on Canadian oil from the U.S. was the tipping point. Washington assumed Canada would bear the cost, but instead, Canada turned east. Why depend on the U.S. when China was eager to strike long-term deals? For years, Canada had seen other energy-producing nations like Russia and Saudi Arabia solidify their energy partnerships with China. Now, Canada has followed suit. The $24 billion Trans Mountain expansion tripled its capacity, ensuring Canadian crude could reach China, Japan, and South Korea directly. This move isn't just about opening new markets. It's about escaping the U.S.-controlled pricing. Canada is no longer at the mercy of U.S. refineries that had long depended on Canadian heavy crude. The U.S. refiners are now paying more due to the tariffs, while China is securing Canadian crude at discounted rates. This shift is a significant win for Beijing, ensuring it has a steady oil supply without Washington's oversight. For Canada, this shift means higher revenues and the freedom to avoid the heavy price reductions that came with being tied to U.S. refineries. U.S. refiners, long accustomed to cheap Canadian crude, are now paying more, while China locks in lower, long-term prices. Beijing has been diversifying its energy sources for years, securing stable deals with countries like Russia, Venezuela, and Iran. Now, Canada has joined that list. For China, securing oil supplies without U.S. interference is part of a broader strategy to reduce dependence on politically volatile regions like the Middle East. Canadian oil is stable, reliable, and free from geopolitical conflict, making it an attractive option for Beijing. For Canada, this move is more than just about diversification, it's about gaining independence. No longer does it need to play by U.S. rules. The shift to China and other Asian markets opens up new opportunities, as Canada is no longer dependent on a single buyer. More buyers mean more revenue, which can be reinvested in infrastructure, energy projects, and future pipeline expansions, making Canada's energy sector more competitive globally. Although it's unlikely Canada will completely cut off oil exports to the U.S. anytime soon, the fact that it now has alternative buyers puts it in a much stronger position. If tensions with the U.S. escalate, Canada can leverage its newfound partners to ensure its energy sector remains stable. The potential for a Canadian oil supply cut could force Washington to reconsider its trade strategies with Ottawa. This shift isn't just impacting Canada and the U.S., it's having ripple effects across the entire Asia-Pacific region. Japan and South Korea, both highly dependent on oil imports, now have access to more competitive pricing, thanks to Canadian oil entering their markets. Likewise, India, which has long relied on OPEC countries, can now diversify its energy imports, reducing its dependence on the Middle East. OPEC, too, is taking note. China, which has traditionally relied heavily on OPEC oil, is now importing more Canadian crude. As this happens, OPEC nations may need to adjust their pricing strategies or offer longer-term deals to remain competitive. Russia is also watching the situation closely. Though Russia has deep energy ties with China, Canada's growing presence in the market could disrupt this dynamic. This shift in energy flows is more than just a change in Canadian oil exports. It's a global transformation. Canada is no longer merely a supplier of oil to its southern neighbor. It's positioning itself as a key player on the global stage. The Trans Mountain Pipeline expansion has allowed Canada to secure long-term contracts with China, ensuring it remains a critical energy supplier. For China, this deal is an ideal fit. Stable, affordable oil with no geopolitical risks. China has worked hard to reduce its reliance on volatile regions, and Canada's oil provides a perfect alternative. This partnership is not just about price. It's about energy security for the future. Politically, this shift is complex for Canada. For years, Canada has worked to balance its relationships with both the U.S. and China. Now, with direct energy deals with Beijing, Canada is stepping away from the constraints of U.S. influence. While the U.S. remains a key trade partner, Canada is no longer tied to its energy policies. Washington is now grappling with the rising influence of China in Canada's economy, and domestic political debates are growing heated over trade, foreign policy, and environmental concerns. Canada isn't taking sides. It's playing its own game. And this game is changing the global energy landscape. By gaining more buyers and more influence, Canada is rewriting the rules. No longer beholden to U.S. pricing and market demands, Canada is positioning itself as a true global energy player. China's need for stable energy supplies means Canada's role is more vital than ever. The U.S. still buys Canadian oil, but it no longer has control over how much it pays. The rules are changing, and Canada is taking advantage. This isn't a short-term shift. It's a new energy reality. The Canadian oil trade is no longer confined to North America. Canada is expanding its reach to Asia, diversifying its markets, and ensuring that it's no longer dependent on any single buyer. The implications of this transformation will reverberate through the global energy market for years to come. The question now is, who moves next? Because Canada has already set its course, and it's ahead of the game. The energy landscape is shifting, and Canada is leading the charge. Stay tuned for more developments because this is just the beginning.